Winter is coming. It's not just a Game of Thrones warning, it might be a reality for the US economy in 2025. Many analysts have drawn parallels between today's AI crazed stock market and the dot-com bubble of the late 90s. And one of the most accurate indicators of a recession hit the news again in December of 2024. The 10-year and the 3-month Treasury yield curves uninverted. And historically, when the 10-year and 3-month Treasury yield curves invert, they have a perfect track record of predicting a recession within 6 to 24 months after they invert. And when they uninvert, you're in those final stages before the recession hits. But it's been 783 days since they inverted, and we have still not seen a recession. So what's going on here? Is the economy just defying gravity, or is a recession bound to happen? I'm Terrell Higgins, your real estate and personal finance guide, and in today's video, I'm going to be breaking down what's really happening in the US economy, why Warren Buffett is holding a record $325 billion in cash, and most importantly, what you should be doing to prepare for what comes next. Let's get into it. So what exactly are these yield curves everyone's talking about? It's not some geeky finance term. It's actually the most powerful tool for predicting economic trends in the United States. So the yield curves are a plot of the interest rates for the treasury bonds of different maturity dates. So the long-term bonds, they generally have higher yields because you're assuming more risk by holding it longer. And the shorter term bonds, they usually have lower yields because you don't have to hold them as long. So when the two invert, meaning that the short-term bonds have a higher yield than the long-term bonds, that is a terrible signal for the economy. That means that investors are expecting trouble ahead. And here's the deal. When the 10-year and the 3-month Treasury yield curves invert, they are very accurate at predicting recessions for the US economy. And they've predicted every recession since the 1960s. But despite the record for that 10-year and 3-month Treasury yield curve, we have seen 8 consecutive quarters of GDP growth, and there has been no sign of a recession. So what is keeping the economy afloat? In one word, tech. AI has been fueling the economy, especially in sectors like software, semiconductors, and in automation. Consumer spending has remained resilient. Unemployment is still hovering around historical lows, and these companies continue to crank out record earnings. But here's the problem. Nothing is permanent. If these companies' earnings start to falter, or if inflation gets out of hand and consumer spending goes away, then this whole house of cards could come tumbling down and a recession could take over the economy. So are these companies just delaying the inevitable recession that's bound to happen? Hold that thought. So Warren Buffett is sitting on a record $325 billion in cash. This is over 28% of Berkshire Hathaway's holdings, and it is the most cash they've held in the company's history. So what is the Oracle of Omaha thinking here? His main trading strategy is to buy undervalued companies and hold them across the long term. But right now, the market is at extreme price to earning ratios. Everything is trading at a super high multiple of their earnings, and nothing is really on sale. Warren Buffett knows that the market is very expensive, and he's just looking for better opportunities to invest that money. Warren has said that he was expecting higher capital gains taxes, so he was trying to position himself to avoid future tax headaches. But that is unlikely to happen under Trump in the next 4 years. And the last reason I think he's sitting on so much cash is because he's planning for the future. Warren Buffett is 94 years old, And at some point, he's going to have to pass the company along to a successor. And it's easier to give them a clean slate to let them invest the way they want to, as opposed to passing on all the legacy companies that Warren is invested in. And I'm sure this is top of mind for him after just losing his long-term business partner, Charlie Munger. So Warren Buffett sitting on a mountain of cash is more a reflection of his own trading strategies and planning for the future for his company than it is a reflection of what he sees going on in the market. So what are other professionals saying about the markets for 2025? It's almost unanimous. Everyone is expecting growth, and more growth. So many experts like to compare today's stock market to the dot-com bubble of the late 90s. And it's easy to see just from the euphoria in the markets, the rapid increase in stock prices, and the unproven business models that a lot of these companies are operating under. But there are some key differences between the dot-com bubble and now. So the underlying technology, AI, actually has a lot of proven use cases across multiple industries. So it is a strong foundation to be building sound business models on. The other thing that is different is that the companies that are employing this technology are sitting on mountains of cash. Google, Microsoft, Meta, all these companies have billions of dollars in cash sitting that they can deploy to develop this technology. And if it doesn't work out, it doesn't affect their underlying business model. This will provide more stability to the stock market than we saw during the dot-com days. So what's my take on all this? If we're in the middle of the dot-com bubble, then we're in the year 1996. And in 1996, Alan Greenspan was the Fed chair for the Federal Reserve. And he was able to cool inflation without causing a recession. And I think Jerome Powell has done a very similar thing. He's been able to cool inflation in the United States without tipping us over into recession territory. He's actually nailing the soft landing. It's very hard to do, but I think he's done a good job of treading that line. And if you look at 1996, what happened was you got some turbulent trading in the middle of the year. So there was a slight pullback, and we could call that a recession, a technical recession. But by the end of the year, the market closed higher. So it came down about 10% across the summer, but the stock market rallied and closed over 20% higher for the year. I could see something similar playing out this year in the stock market. Some decline or turbulence early in the year or mid-year, and then closing higher at the end of the year. So maybe a target around 6,600 for the S&P. That's about 12 to 13% higher than it is right now. If you made it this far in the video, please do me a favor, hit that like button, subscribe to the channel so more and more people can hear this message. So what should you be doing with your finances? Just stay invested in the market. Time in the market always beats timing the market. And here's a stat for you. If you invested $10,000 into the stock market in 1980, you would have over $1 million right now. And there have been 14 different market events where the market has pulled back. You could have ignored all of those and just stayed invested, and you would have over $1 million. But if you were not invested for the best 5 trading days from the 1980s to now, you missed out on 37% of your gains. And if you were not invested for the best 30 days since 1980 to now, you missed out on 83% of your gains.
No, don't like that.
So just stay invested. Don't panic. ride the wave, and everything will be fine. So that dot-com bubble crash is not likely to happen this year, but that means that it is a perfect year to start recession-proofing your finances. This is a good opportunity to build up your emergency fund of 3 to 6 months. This is going to be your cushion when things get tough. And you can start paying off your high interest rate debt so you're lowering the number of liabilities you have in case unemployment hits. And make yourself indispensable at your job. Improve your skills, start networking, and make yourself a vital cog in the machine so when layoffs hit, you're not the first one out the door. And if you can diversify your income streams with a side hustle or a side business, by all means, now is the time to do it while the economy is still humming along. So here's the thing, whether a recession hits to 2 days from now or 2 years from now, you can't control the economy. All you can do is focus on your own finances. Warren Buffett isn't panicking about it, and neither should you. Strengthen your financial foundation, protect your income, and invest for the long term. And if you're curious what you should be investing in over the next 4 years to maximize your returns, I did an entire video on that topic. Keep getting 1% better every day, and I will catch you guys next time.